Hi, today we're going to have a look at the 2023 DEB mock question 1. It is a final accounts question and it's a sole trader. The name of the person is Bobby Byrne. So as per usual with these question 1s, we're giving a trial balance here, the balances. We are given some additional notes and then we are asked to prepare, down at the bottom, we're asked to prepare a trading profit and loss and balance sheet. So first of all, we're going to have a look at the notes. The first note is a common note 1, which says that stock which cost at the end of the year, 31st of the 12th, was 68,800. This figure includes fire damage stock which cost 8,600, but now has a net realizable value 30% of cost. So we can now sell it for 30% of the cost, so 30% of 8,600. So to start off this first note, we're just going to get closing stock per note 1, which is 68,800. We are going to take away the damage stock, which was 8,600. And we're going to add the net realizable value, which was 30% of the cost price. So it is 30% of 8,600. If we wanted to sell it, we would get 30% of that. So we would get 2,580. So at the end, then in total, stock will be worth $62,780. And there must be another change to closing stock later on because I didn't write down where closing stock goes in the accounts yet. Note 2 relates to goods with a retail selling price of 9,600 were returned to a supplier. So they are purchases returns. The selling price of these goods were cost plus 25%. The supplier issued a credit note showing a restocking charge of 10% of the cost price, and no entry was made in respect of the restocking charge. So all we have to do here is account for the restocking charge. If there is a restocking charge on purchases, we treat it like a purchase. And if there was a restocking charge on sales, we would treat it as a sale. So in this question, it's a restocking charge on purchases because the goods were returned to a supplier, purchases returns. And the restocking charge is 10% of the cost. So we need to work out the cost, price, and get 10% of it. And that will be a restocking charge. So the cost price from the question is the selling price is 9,600, and that's cost plus 25%. So the selling price is 9,600. So that's 125%. So the cost price, which is always 100%, is 9,600 divided by 125 multiplied by 100. So the cost price is 7,680, and the restocking charge is 10% of the cost price. So I'm going to get 10% of the cost price, which is 768. And because that's a restocking charge on purchases, we just treat it like a purchase. So with purchases, we will add it to purchases and we'll add it to creditors. So I'm going to get my creditors figure from the trial balance. So anytime we have a restocking charge on purchases, you just add it to purchases and add it to creditors, because creditors always go with purchases and debtors will always go with sales. So from the trial balance, if we go back to the trial balance and get our creditors figure here in the trial balance, creditors is 68,900. And I'm adding my restocking charge of 768. So creditors are now 69,668. And again, there will be another adjustment to creditors later on. Purchases from the trial balance is 858,000. And again, I'm adding my restocking charge of 768. So the restocking charge, because it's a purchase return, the restocking charge will affect purchases and creditors. Note 3, which is a very common note, nearly always comes up every year, is where they buy and sell a van. So provide for depreciation on delivery vans at an annual rate of 20% of cost from the date of purchase to the date of sale. And in some of the more recent questions, they would say provide a full year's depreciation in year of acquisition and none in year of sale, which is slightly different, but we'll just work with this one for the moment. Then on the 30th of April 2022, a van which had cost 36,000 on the 1st of July 2019 was traded in against a new van which cost 42,000. An allowance of 18,000 was given on the old van. Okay, so we're given 18,000 off the price of the new van as an allowance for the old van. The check for the net amount of this transaction was entered in the bank account, so that's okay, but was incorrectly treated as a purchase of trading stock. As this person here is not a garage, if they purchase a van, it shouldn't go on purchases because it's not a day-to-day purchase for the company. It is a fixed asset, so it shouldn't have went on purchases. So we need to take out the net amount out of purchases later on. And these were the only entries made in the books in respect to this transaction. So the first two notes we are going to do is in respect of the old van, because we need to see whether we made a profit or loss on the old van. So the first thing, before we see whether we made a profit or loss, we have to work out the depreciation of the old van. And to do that, we have to see how long we had the old van for. So I think the easiest way to work out this is to see how many full years we had it for and then how many months. So if we bought it at the start of July 19 and we're getting rid of it at the end of April 22, we had it for all of 2020 and all of 2021, which is 2 years. We had it for 6 months the year we bought it and 4 months the year we sold it. So that would be 2 years and 10 months. And the cost of that van was 36,000. So we had it for 2 years and 10 months. If the cost is 36,000 and the depreciation is 20%, that's 7,200. So 3,600, so 36,000 by 20%. There's 1 year's depreciation, which is 7,200. And then to get the 2 years depreciation, we multiply it by 2 is 14,400. And then if 1 year's depreciation is 7,200, to work out the 10 months, if I divide by 12, it'll give me 1 month. To multiply it by 10, it'll give me 10 months, which is 6,000 for the 10 months. So for the 2 years and 10 months, the depreciation of that van was 20,400. Now we need to see whether we made a profit or loss in the van. So that van cost us 36,000. The depreciation we're after working out to be 20,400. And we'll take away the depreciation. So the net book value, or what that van is worth, is 15,600. Now, in the question, it says we got an allowance of 18,000 off the new van. So if the allowance is greater than the net book value, we would have made a profit. If it is less than the net book value, we would have made a loss. So in this question, the van was worth 15,600. We got an allowance of 18,000. So we made a profit of 2,400. And that profit will go in operating income in the profit and loss. My third note, again, so that's the first two notes done. Usually you have to do 6 notes for this part of the question. The first 2 notes are to do with the old van, and the third note is a very straightforward note on cost of vans. So if we go to the trial balance, the cost of delivery vans is 140,000. Then we have to take away the cost of the van we sold. So the cost of the van we sold was 36,000. And then we need to add the cost of the van which we bought, which is 42,000. And when we total those, my new cost of vans is 146,000, and that figure will go in the fixed asset note in the balance sheet. So that's 3 of the notes done. The next 2 notes are to do with depreciation. We need to work out the depreciation of vans for the year. And then when we have that done, we can work out the accumulated depreciation of vans. So to work out the depreciation of vans for the year, first of all, we need to see when we bought and sold the van. So that happened at the end of April, so after 4 months. So when we're working out the depreciation, we're going to split it up into 4 months and 8 months. For the first 4 months, the cost was the same as it was in the trial balance, 140,000. Then we sold the van and bought a van. And for the next 8 months, the cost went up to 146. So for the first 4 months, the cost was 140,000. Depreciation was 20. And to work it out for 4 months, I multiplied by 4 over 12. For the next 8 months, the cost was 146,000. Again, I'm going to multiply it by 20% because that's the depreciation rate. And to get 8 months, multiply by 8 over 12. And then in total, they come to 28,800, which is my depreciation of vans for the year. So that will go as a selling and distribution expense in the P&L, because delivery vans have to do with distribution. So that's selling and distribution expense. The next thing I need to work out is the accumulated depreciation of the delivery vans. So in the trial balance so far, the accumulated depreciation of vans are, well, if the cost is 140 and they're now worth 62, the accumulated depreciation would be the difference. So 140,000 minus 62,000, which is 78,000. Now I'm going to add my depreciation for the year, because that wasn't included in the trial balance. That was an additional note, so that needs to go in also. And I need to take out the depreciation of the van that I sold, because we don't have that van anymore. So the depreciation of that van needs to be taken out, and the depreciation of that van is 20,400. So now my accumulated depreciation of vans is 86,400, and that will also go in the fixed asset note in the balance sheet under depreciation. And the net amount of the figure has to be taken out of purchases. So again, if I had no notes so far on purchases, I would just get my figure from the trial balance and use that one. But I have an adjustment to purchases already, so I need to go up to my most recent purchases figure here from note 2. And I need to take out the net amount. So the new van is costing 42,000, but they're giving us an allowance of 18. So the net amount we would have to have paid was 24,000, and that has to be taken out because that shouldn't go in purchases. It should go into fixed assets. So now my purchases figure is 834,768, and there's no more changes to purchases later on. So that's the figure that will go in cost of sales in the P&L for purchases. Note 4 is to do with suspense. So as usual, kind of with the suspense note, the first figure is usually, the first mistake is usually to do with either mortgage interest or debenture interest. And you see, and here kind of splits it up. There's usually a second double entry error here where it was entered in one account and not another. So there's usually two things going on in this. So again, with this suspense one, suspense arises basically when there is an error or a mistake. So they're saying there's an incorrect figure for mortgage interest, okay, and although the correct figure has been made in the bank, so we don't need to worry about the bank. So the figure for mortgage interest here in the trial balance is incorrect, so we need to go over to mortgage interest here. So mortgage interest paid for the first 6 months, that 5,600 is incorrect, so we need to work out the correct figure. So now I need to look at my mortgage. So it's a 5% mortgage anyway, that's the rate of interest. At the end of the year, it was 280,000, and that includes 80,000, which was received on the 1st of the 10th. So after 9 months, the mortgage went up 80,000. At the end of the year, it was worth 280, so it must have been 200,000 before that. Usually, it's only in the last kind of year or two that these months don't correspond. So usually, if the mortgage interest was for the first 6 months, the mortgage would have changed after 6 months, which is slightly easier than what's going on here. So here we need to work out the mortgage interest for the first 6 months. We also need to work out for the mortgage interest for the next 6 months. But unfortunately, it has changed after 9 months. So we're going to have to split it up into 6 months. And instead of 6 months and 6 months, we'll have to split it up into 6 months, 3 months, and then another 3 months. Okay, and we'll see why now when we do the note. So mortgage interest, the first mortgage interest for the first 6 months was incorrect, so I need to work that out. So the mortgage is 200,000, the rate of interest is 5%, and for 6 months I'm going to multiply it by 6 over 12. Now, if the mortgage had stayed like that, I could have just say 200,000 by 5% by 6 over 12 again would give me the other 6 months, but it changes after 9 months. So for the next 3 months, again, it's 200,000. And again, for the suspense, we only really needed this 5,000, okay? But for the question, we need to work out the mortgage interest due, which would be these two figures together. And for the profit and loss, I need the total mortgage for the year. So you're as well off just doing it all now instead of going back and doing it later on. So the next 3 months are 200,000 by 5% by 3 over 12. And then the next 3 months, the mortgage went up to 280,000. Again, the rate of interest was 5%, and again, to work out 3 months by 3/12. So the total mortgage for the year is 11,000. And again, I didn't write that that went down the bottom of the P&L because I think there's a small change to that later on. These figures won't change. These are the mortgage interest that's still due. We paid the first 6 months, even though it was incorrect. We'll look at that in a minute. And the next 6 months are still due, which come to 6,000. So they will be a liability less than 1 year in the balance sheet. We still owe that 6,000. So the mortgage interest should be, we're after saying it should be 5,000. In the trial balance, remember we said it was incorrect. Mortgage interest for the first 6 months was 5,600, which is incorrect. So the difference is going to be 600. Now, to see whether we add that 600 to suspense or take it away, the easiest way to do that is little t accounts. So mortgage interest for 6 months in the trial balance is 5,600 of a debit. We worked it out here and we said it should be 5,000. So if it's a debit of 5,600 and it should be a debit of 5,000, we put in a credit of 600. So now we have a balance of 5,000 here on the left. And whatever side we put it here, we're always going to put it in the opposite side of suspense. So if this should have been 6,000 and we want to put 400 here to get up to 6,000, the 400 will go on the opposite side. And again, what account is suspense in here? Suspense is in the insurance account. It won't always be insurance. Sometimes it might say salaries and general expenses, including suspense. Sometimes advertising, including suspense. So you just have to be careful what account suspense is included in. The very occasion or odd time, it might be an account of itself, but not usually. So the insurance, including suspense, is 25,600. And because that 600 was entered on the right-hand side, or the credit side here, we put it on the debit side of suspense. So that's the first completed. And we'll do this, the suspense account in a minute. We'll just look at the second part of the question first. So now the second part says there was a VAT payment of 3,800 entered only in the bank account. So whenever I'm looking at the second part of this question, I'd always do like the 2T accounts for what accounts are affected. I'd circle what should have happened, then it was put in one account, so you don't need to do anything there. We need to put it in the other account, and the opposite will go into suspense. So if it's a VAT payment anyway, the two accounts are going to be VAT and bank. And the amount is 3,800 and it was entered only in bank. So I set up my VAT account and my bank account, and again the red figures is just a trial balance figure. If it's a VAT payment with bank, you always debit money in and credit money out. So if it's a VAT payment, it'd be money out, so it should go on the credit side of the bank account, and that would mean it go on the debit side of the VAT account. So in grey there is what should have happened. In the question it says it was entered only in the bank account. So it was entered in the bank account, that's fine. We don't need to do anything with bank. We need to put it in the VAT account, and the amount was 3,800. So I need to put the 3,800 in the VAT account here where it should have went. And again, it's going to go in the opposite side of suspense. Okay, it's always the opposite side. So if I need to put it in, let's say it was entered in VAT and not in bank. If I needed to put it in bank, I would put the 3,800 here, and then it would have went on the opposite side here of suspense. So my notes, I don't need to do a note on here for the mortgage interest. I don't need to do a note because we use the correct figure for mortgage interest in our workings. I need to do a note on insurance. So the trial balance figure is 25,600. So per the trial balance, insurance including suspense is 25,600. The VAT amount is on the opposite side, so I'm going to take away the 3,800. So less VAT, 3,800. And the mortgage interest was the same side, so I'm going to add that 600. And that 3,800 VAT, I'm going to take away. So in total now, after fixing the suspense errors, insurance is now 22,400, and insurance is an admin expense in the profit and loss. With my VAT, currently my VAT is a credit of 4,500, so it's a credit of 4,500, and because the 3,800 is on the debit side, I'm going to take it away. So now that's going to leave me with a credit balance of, a credit balance of 700, because 4,500 is 700 bigger, 3,800, and it's a credit balance on the right hand side. And VAT is going to be a liability less than 1 year in the balance sheet. Because the balance is on the right hand side, sometimes if it's a debit balance, it would be an asset, but this time it's going to be a liability less than 1 year in the balance sheet. Because liabilities have a credit balance and assets have a debit balance. The next note, note number 5. So this is straight away I can see sale or return, okay, and that's in commas there because it comes up quite a lot, and just to draw your attention to it. So that is sale or return. So usually years ago, whenever they asked sale or return, it was goods that we gave to a customer and asked them did they want to buy them. Okay, so that would be like if we send them goods and say they can buy them if they want or return them to us. So it's either a sale or a return. So we shouldn't treat it like a sale unless it's an actual sale. In more recent years, sometimes it's goods that were sent to us on sale or return, which would actually be a purchase for us. So you need to be careful in the last couple of years when you're reading the questions about sale or return. So these were goods that were sent to a customer. So these were sent to a customer. So these are sales from our side, okay? They were sent to a customer as a sale or return at the end of the year. These goods were recorded in the books as a credit sale of 37,200, and that is a markup on cost of 25%. So that's the 125%. Because these were a sale or return, they shouldn't have been treated like a sale, so we have to do the opposite of what we would have done when we said they were a sale, basically. Okay, and remember, when we're doing these notes, cost goods are always stock is always valued at cost price, and sales and debtors will always be at sales price. And if you're doing it the other way around, if there are goods that were sent to us that we purchased, purchases and creditors will always be at cost price. So stock is always at cost price, and sales and debtors are selling price, and purchases and creditors are cost price. Because you purchase something at cost price and then you sell it at the selling price to make a profit on it. So to do this note, because we didn't actually sell these goods, okay, we need to add them to stock. Because when we said we sold them, we would have taken them away from stock because we said they were sold, but they weren't actually sold, so we need to add them back to stock. We need to, when we said they were sold, we said we would have treated it as a sale. So now it's not a sale, so I need to take it away from sales. And when we sold them, we would have said to the debtor or the person we sold them to owed us the money. Now, it wasn't actually a sale, so they don't owe us the money, so we need to take it from debtors. So anytime it's a sale or return on goods that we sent to a customer, we're going to take it from sales because we didn't sell them. We're going to take it from debtors because the person doesn't owe us the money for them. And we're going to add them back to stock because we didn't sell them, so they shouldn't have come out of stock, so we need to add them back to stock. Stock is going to always be a cost price, and sales and debtors will be a selling price. So I need to work out the cost price and the selling price. So sometimes you may be given the cost price, sometimes the selling price, so you need to read the question carefully. It's saying that these goods were 37,200, and that's a markup on cost of 25%. So that's the selling price. So the 37,200 is the selling price. So to get the cost price, I need to divide that by 125 and multiply it by 100 because cost is always 100%. So 29,760. So closing stock. If I had no adjustment to closing stock already, I'd take the figure from the trial balance, but I have an adjustment to closing stock up here. So closing stock is 62,780, and I need to add the sale or return, and stock is always at cost price, so I'm adding 29,760, and that comes to 92,540. And now we're finished with closing stock. There's no more adjustments to closing stock. So that's the closing stock figure that's going to go on the cost of sales and the profit and loss. And closing stock will also be a current asset in the balance sheet always. Debtors, we've had no change to debtors so far. So I'm going to take my debtors figure from the trial balance. So debtors from the trial balance is 82,300. And I'm going to take away the sale or return, and that is going to be debtors are at selling price. So I'm going to take away 37,200. And that is going to give me 45,100. And again, there must be another change to debtors later on because I didn't write where it goes in the accounts yet. And the sales from the trial balance, my sales figure is 1529000. And I'm going to take away the sale return, which is always a selling price. Sales are always a selling price. So I'm going to take away the 37,200. And that's going to give me sales of 1,491,800. And there's no more change to sales. So that's the figure that's going to go at the very top of my trading profit and loss account of the P&L, 1,491,800. The next note is about a creditor. So this is the person that we owe money to, a creditor. We owed them 12,600, but they accepted office equipment, which is worth 11,000 in full settlement of the debt. So we gave them the equipment, which is worth 11,000, and now we don't owe them the 12,600 anymore. The equipment cost us 15,000, and no entry was made in the books in respect of this transaction. So we need to make all the entries, and then we need to provide for depreciation on equipment held at the end of the year at a rate of 15% of cost. So the first note I'm going to do here are creditors. Okay, so if there was no change to creditors, I would take the trial balance figure, but there is a change to creditors. I think we have a change to creditors up here. Yeah, so per note II, creditors is, maybe I had a more recent. No, I think, yeah, the most recent creditors figure is 69668, and that was per note, not IX. It should be II from note 2. And then we don't owe the creditors any money anymore. Okay, so even though the equipment we gave them was only worth 11,000, they accepted that in full settlement of this debt of 12,600. So I don't owe creditors 12,600 anymore. So I'm going to reduce creditors by 12,600. And again, there must be a change to creditors again later on because I didn't write where it goes in the accounts. The cost of equipment. So the cost of equipment from the trial balance, office equipment costs 35,000. And I need to take away the cost of the equipment that we gave the creditor because we don't have that equipment anymore. So that equipment costs 15,000. So that needs to come out of cost of equipment. So now the cost of equipment, which is going to go in the fixed asset note in the balance sheet, is 20,000. Because we didn't give them the full amount of the debt, effectively we received a discount. Okay, so in the trial balance, the discount figure is, and again, discount is net. The discount account is made up of lots of different discounts allowed and discounts received, and whichever is greater, the balance is going to be on that side. So at the moment, it's a debit balance of 2,500. Okay, and because we received a discount, it's good, it's income. So income always has a credit balance and expenses always have a debit balance. Okay, the discount that we received, well, we owed them 12,600 and the equipment was only worth 11,000. So effectively we received a discount of 1,600. Okay, and that's a credit balance. So now if we take away those, we are going to be left with a debit balance of 900 because the debit figure is bigger than the credit figure. So we have 2,500 on the left and 1,600 on the right. So the balance on the left will be 900, and because it's a debit balance, it's an expense, and it's going to be a selling and distribution expense in the P&L. If it was a credit balance, it would be good. It would go in operating income. It would be income. We need to work out now the depreciation of equipment for the year. So the equipment, it's a depreciation of equipment. To provide for depreciation of equipment held at the end of the year at a rate of 15%. So the depreciation we had at the end, the equipment we had at the end of the year is 20,000. We've worked that out up there. Okay, and I'll just change that year end because that's obviously from a different question. So the cost at 31st of the 12th, 22 was 20 grand. The depreciation rate in this question is 15%. So 15% of 20,000 is 3,000, and depreciation of equipment is an admin expense in the profit and loss. Accumulated depreciation of equipment. We need the accumulated depreciation of equipment for the balance sheet, so we may as well do that now also. So from the trial balance, depreciation of equipment. Well, it cost 35 and it's now worth 21. Okay, so the difference would be the accumulated depreciation. So 35 minus 21 is 14,000. Now I'm going to add my depreciation for the year of 3,000, and I need to take out the depreciation of the old equipment, same as we did with the old van or the van we sold earlier. This equipment, we don't have it anymore. So how much was the depreciation? If you look back in the note here, the office equipment cost 15 and a net book value of 11. Okay, so if it cost 15 and it was worth 11, the depreciation would have been the difference, which was 4. So now my accumulated depreciation of equipment is 13,000, and that's going to go on the fixed asset note in the balance sheet. The next note is to do with bank reconciliation. Okay, so basically what goes on here is we have a figure for bank in the trial balance. So if we go to our trial balance and look at bank here, it's 31,700 for credit balance. So we're saying we have an overdraft of 31,700. Then we get a statement from the bank showing that there is an overdraft of 16,700. We need to reconcile these two figures. So if there are transactions that we don't know about, they will affect our bank figure. If there's a transaction that we know about that the bank doesn't know about, it will affect the statement figure. And at the end, the two figures should be the same. So the first thing here, anyway, there's a credit transfer of 2,600 received at the end of the year from a debtor in respect of a debt previously written off. So basically, there was a bad debt written off before. Now, this person's actually given us some of the money. He's given us 65% of the money, and he said he's going to give us the remainder of the money within 3 months. So he's going to give us the other 35%, so we're going to get all the money back effectively. And no entry was made in the books in respect to this transaction. So because this 2,600 was paid directly into the bank, we didn't know about it, so we haven't accounted for that in our bank figures, so we need to do that. So the 2,600 that we received, so we received 2,600, and that's 65%. So 2,600 divided by 65 multiplied by 100 is that the full amount was 4,000, and the bit we're still owed, the difference of 35%, is 1,400. So these three figures need to go into the accounts. Well, if we received 2,600, that is going to reduce our bank overdraft. So from the trial balance, we're saying we have a bank overdraft of 31,700. 31,700, and that's a bank overdraft. So if we receive money, it's going to reduce our overdraft. So that 2,600 is going to bring down my overdraft. So it's now 29,100. The 1,400 I'm still owed, we are going to get in the next 3 months. So I'm going to add that on to debtors because they owe us the money they owe us at 1,400, and say they're going to pay us in the next 3 months. So that 1,400 will be added on to debtors, and when we receive it, the debtors will reduce again. So from note 5, I have a change to debtors already. So my most recent debtors figure is 45,100, and I'm going to add that 1,400 that we're owed now, because it was previously written off, but now he says he's going to give it to us. So debtors are now 46,500, and debtors are always a current asset in the balance sheet. And the full amount, I received 2,600. I'm going to receive the other 1,400. So in total, I'm going to be up 4 grand because that was previously written off. Now we're going to get it all back. So that 4,000 is going to be what's called a bad debt recovered, and that's going to go in operating income in the profit and loss. If originally when it was a bad debt, it would have been a selling and distribution expense, but now it's a bad debt recovered. We're getting the money back, that 4,000. So that's the first part of the bank note done. The second part of the note says there was investment income earned in 2022 was lodged directly into the firm's bank account. Okay, so investment income earned in 2022 was lodged into the bank account. So again, because this was lodged directly into the bank account, we weren't aware of it. So we need to put that figure into our bank. So the investment income. So I need to go over to my investments here. So I had 200,000 investments and we got them on the 1st of May. So we had them for 8 months and the rate of interest is 3%. So to work out the investment income, it's 200,000 by 3% by 8 over 12 because we had them for 8 months. So 200,000 by 3% by 8 over 12. And we didn't receive any of that. If we had received some of it, we'd take it away and the remainder we would be still owed, but we haven't received any of it. So that 4,000 we're still owed. Sorry, we have received it actually here. Sometimes you won't have received it all. So if you haven't received it all, whatever you've received you take away, and the remainder we will be still owed. It will be a current asset in the balance sheet. But here in this question, we actually have received it all. Okay, so that 4,000 is going to go. Investment income is always added on its own down the bottom of the profit and loss. And because we received the investment income, again, it's going to reduce my bank overdraft. Okay, so that's going to be minus the investment income. We received 4,000, so our overdraft is going to go down by another 4,000. So it's currently 25,100. The third part of the note, a cheque of 3,500 issued to a supplier has been returned. So we wrote a cheque to a supplier for 3,500 and that was returned back to us. And that was not entered in the books. Okay, so when we wrote a cheque to a supplier, that would have originally increased our bank overdraft because we wrote a cheque. Now it's been sent back to us, so the cheque isn't in effect anymore. It's not going to be cashed. Okay, so because we're not paying that person the 3,500, my bank overdraft is now going to go down by 3,500 again. Because if we had paid him and he lodged it, the overdraft would have went up by 3,500. But for some reason they sent it back, so it's going to reduce our bank overdraft for 3,500. And again, I am going to have to add that on to creditors because I thought I paid them, so I would have reduced creditors by 3,500 because I said I paid them. I don't owe them that anymore. But because they sent the cheque back, I still owe the creditor that 3,500. So the most up-to-date creditors figure is from note number 6, I think here, yeah, 57068. And I need to add that amount of 3,500 because I still owe the creditor that 3,500 because the cheque wasn't sent to him. So creditors are now 60,568 and creditors are always a liability less than 1 year in the balance sheet. We owe the creditors the money within a year, usually within a couple of months. Now, so that is the third note done. Now, the fourth note here was a cheque of 4,800 in respective rates has not been presented for payment. So we wrote a cheque of 4,800 for rates, but it wasn't cashed yet. So we do know about this cheque, okay? So we actually don't need to do anything to our bank figure, but it hasn't hit the statement yet, so the bank doesn't know about it. So currently, and again, this is just a little reconciliation here. So per the statement, we're saying that it's 16,700. Then the outstanding cheque, okay, they're saying there's an overdraft of 16,700, but they don't know about this cheque of 4,800 that we wrote that wasn't cashed yet. So when that's cashed, it's going to go up by 4,800 from their statement figure. And that comes to 21,500. Now these two figures in yellow then should always be the same. This is out by 100. I think there's a mistake in the question. Maybe that should be 16,800, not 16,700. Okay, so I think maybe there's a mistake in the question. So these two figures in the yellow should always be the same. There are €100 out there, but they should always be the same. So the last one there, note 4, didn't affect our figure. We just added it to the figure in the statement, and then that should reconcile or tie in with our figure. Okay. Note number 8 is to do with revaluation of land and buildings. So buildings are to be depreciated at 2% of cost per annum, and the land was 250,000. The reason they're telling us the land figure because you don't depreciate land, so we need to take that away from the land and buildings before we depreciate it. And then we revalued land and buildings at the end of the year. Now it's important when we look at the revaluation, the date is important. If you revalue it at the end of the year, you add this year's depreciation. If you revalue at the start of the year, you will not add this year's depreciation. So to have a look at this note, land and buildings in the trial balance, land and buildings is 950,000. But before we work out the depreciation, we have to take out the land element of 250 because you don't depreciate land. So it's going to be 950,000 minus 250,000. The depreciation rate in the question is 2%. So 2% of 700,000 is 14,000. And depreciation of land and buildings is always an admin expense in the P&L. Now, to work out the revaluation reserve, I'm going to get the new cost and take away the old cost. So it's revalued to 1.1 million from 950,000. So the increase is 150,000. I always add my accumulated depreciation, okay, and the accumulated depreciation I get from the trial balance. So land and buildings, the cost 950, and they're now worth 894. So the difference between those is 950 minus 894. 56,000. And because the revaluation was at the end of the year, at the 31st of the 12th, I'm going to add this year's depreciation. If it was at the 1st of the 1st, you would not add this year's depreciation. So because it's at the 31st of the 12th, I'm going to add this year's depreciation of 14,000 also, which gives me a revaluation reserve of 220,000. And that always goes in the finance by section at the bottom of the balance sheet. Note number 9 says provide for mortgage interest due. Okay, we have that done already up here. And remember when we were doing the note on suspense, I said we'd do that now. The mortgage interest due, the 6 months, the 3 months, and the 3 months. So mortgage interest due is 6,000. So we have that done. We don't need to do that. And then it says 20% of the mortgage interest for the year is to be attributed to the private section of the buildings. Okay, so because this is a sole trader, sometimes they pay stuff from the company accounts or from their own accountants. That's not the company expense. So when that happens, we just take it out of the expense and we add it to drawings. So this time it's to do with mortgage, so we're going to take it out of mortgage and add the drawings. If they paid insurance for the private section of the building, we would take it from insurance and add it to drawings. So it's 20% of the mortgage interest. So from note IV, so again, if I go up to note IV here and get my total mortgage interest, which is 11,000. And remember I said earlier, that's why I didn't write where it went, because we weren't finished with it. So the 11,000 and 20% of that has to do with drawings. So I need to work out 20% of that and take it away. So I'm taking away 2,200 because it's to do with the private section of the house. So 8,800 is the business expense for mortgage interest, and that's always taken away at the bottom of the profit and loss on its own. And then I just always added the drawings. So drawings is money that the owners take out for their own use. So drawings currently is 34,800. And I need to add the 2,200 because they've taken out another 2,200. So drawings now is 37,000. And again, that goes into finance by at the bottom of the balance sheet. And the last note is to do with a bad debt provision. So provision for bad debts should be 4% of debtors. So I need to get my debtors figure, and again, if there's no change to debtors, I use a trial balance figure, but there has been a change, so I use my most recent debtors figure. So debtors are now 46,500, and the provision is 4%. So 4% of 46,500 is 1860. So the bad debt provision should be 1860. Now we need to see what it is currently in the trial balance. So it's currently 3,200. Sometimes we need to increase the provision, which is bad, and sometimes we can reduce our bad debt provision, which is good. So currently the bad debt provision is 3,200. We worked it out and we said it should be 1,860. So to get it from what it is in the trial balance to what it should be, we are going to reduce it, which is good. It's going to decrease. So to get it to what it should be, it's going to decrease by 1,340, and because it's a decrease in a bad debt provision, it'll go in operating income. If it was an increase, let's say it should have been 4,000, and we needed to increase it from 3,200 to 4,000, it needed to increase by 800, and that would be bad. It would be an increase of 800, and that would be a selling and distribution expense. So that's our notes now completed. Now we need to fill in the accounts. So when we're filling in the accounts, if there has been no change to the figures, you will just take the figure from the trial balance. If there is a change, we will take the figure from the notes. So my first figure is sales, and there was a change to sales. I remember there being a change to sales somewhere. So I'm just going to go back to my notes and go up to sales. So here was a change to sales. So my final sales figure is 1,491,800. Less cost of sales is the heading. Opening stock. We'll always get opening stock from the trial balance. That should never change because that was last year's closing stock figure. That was the figure that was signed off in the account. So the opening stock figure should never change. So stock at the start of the year is 72,300. There are a few changes to purchases. So again, I need to go to my notes, and again I'm going to start off down the bottom and work my way up, because then I'll hit the most recent change to purchases first. So if I look back through my notes, and again that's why it's handy to do your notes in red, because it's easy to spot the heading. So I should just see purchases hopefully quickly enough when I go up here. So again, there's purchases, and the most up-to-date figure is 834768. So opening stock, I'm going to add my purchases to give me 907068, and I'm going to take away closing stock. So again, I'm going to go back to my notes and get the figure for closing stock. And again, I think that changed a couple of times early on. So yeah, 92540, that's the final figure. So 907068 minus my closing stock gives me cost of sales of 814528, and sales less cost of sales gives me a gross profit of 677272. Now I need to add any other income I had. Usually you'd have maybe 2 other operating incomes, just 4 in this question, which is a good bit. So there's a profit on the sale of van, and when we bought and sold the van, that note, there was a profit on sale of van. So here, profit on sale of van 2,400. There was a bad debt recovered towards the end in the bank reconciliation. We had a bad debt recovered. It's $4,000 as far as I remember. There was a reduction in the bad debt provision, which is the last note we did. So if the bad debt provision is reduced to what it should be, that's good. So there's a decrease or reduction in bad debt provision, 1340. And then we also need to check our trial balance. See, is there any income? So the income will always be on the right hand side of the trial balance. So if we look down through here, I can see that rent. Now there's 3 accounts you need to watch out for: rent, commission, and discount. They can be either income or expenses, depending on, like with rent, if you're renting out a building to someone else, it'll be income. If you're renting off somebody, it will be an expense. Same with discount, you get discounts allowed and discounts received, so depending on which side the balance is on. And commission, we might get commission for selling products, or we might pay commission to salespeople. So if they're on the right hand side, they're income, on the left hand side, they're expense. So this rent here is on the right hand side, that's rental income of 10,000. So in total, they come to 17,740, and because they are income, I'm going to add them onto my gross profit above. Now I need to take away my expenses. So up as far as gross profit will always be the same. Then we add operating income, whatever few bits of income, extra income that we have. Now we need to take away our expenses. So expenses can be either administration or selling and distribution. Selling and distribution as anything that has to do with sales, like advertising or a discount, okay, and sales. Sometimes give a discount on sales, they're doing selling. And distribution would be to do with kind of delivery vans, so depreciation of delivery vans. And if there was a loss on sale of delivery van, that would also go down here, but there's not in this question, there was a profit. And then generally everything else goes into administration expenses. So my first administration expense is depreciation of land and buildings. So I did that along with my revaluation note down at the end here. So depreciation of land and buildings for the year is 14,000. Insurance, I think insurance was where Suspense was. I just had to double check. Yeah, insurance was where Suspense was. So to work out my insurance, I'm going to go back to Suspense note. Here, insurance is 22,400. Then depreciation of equipment, I worked that out when I gave the equipment to the creditor. So this note here, depreciation of equipment for the year, 3,000 again, that's an admin expense. Rates, there's no change to rates, so we just need to, that's from the trial balance. As I said, if there was changes, you take them from the notes. If there's no change, don't forget to take the figure from the trial balance also. So rates didn't change, and it's a debit balance, means it's an expense of 21,200. And salaries and general expenses, there was no change to salaries and general expenses here. So again, that's an expense, 124,400. Selling and distribution expenses. So advertising is the first one. Again, I don't remember any change to advertising, so that's going to be taken directly from here, 21,500 from the trial balance. The discount, there was a note on discount because we received a discount when we gave the person the equipment. So again, if I go to the note here on the discount, is 900 to selling and distribution expense because it's a debit balance. And depreciation of delivery vans we worked out when we bought and sold the van. So the depreciation of the vans for the year is 28,800. So now I'm going to total my admin expenses. I'm going to total my selling and distribution expenses. And then over on the right, I'm going to add both of those together to give me my total expenses. So admin is 185,000, selling and distribution 51,200. So my total expenses come to 236,200. And because they're expenses, I'm going to take those from the profit above. Okay, so I'm going to take it from the profit above, which leaves me at 458,812. Now I have to add my investment income and take away my mortgage interest, because investment income is good, it's going to increase the profit, and mortgage interest is bad, I pay that, it's going to decrease my profit. And again, they always have to be disclosed on their own at the bottom of the profit and loss. So the investment income, I worked it out towards the end, I think it was 4,000 as far as I remember down here. Investment income was 4,000, I'm going to add that on. And my mortgage interest, it was 11,000, but remember then that we received, 20% of that was to do with drawing, so I had to take that away. So my most recent, or the correct figure is 8,800, and I'm going to take that away because it's bad. You have to pay mortgage interest. So my profit for the year is 454,012. Now to do the balance sheet. So the balance sheet, the first thing we're going to have are our tangible fixed assets. So here, the first thing that's going to go in is land and buildings. So land and buildings, remember in the notes, land and buildings were revalued at the very end of the year. So they will be that figure. They were revalued to 1.1 million. So they're going to be 1.1 million. And when we revalue the land and buildings, remember we put the depreciations in the revaluation reserve, okay, at the very end of the year. So we kind of cleared out the depreciation. So when you revalue at the very end of the year, you're never going to have depreciations. That's going to be 0. So we'll take those away and it's still 1.1 million. The cost of delivery vans. So I'm going to get that from the note where I bought and sold the van. So the cost of vans are 146,000. The accumulated depreciation I'm also going to get from that note. Accumulated depreciation of vans, 86,400. And then I'm going to take those away. Office equipment, I'm going to get these figures from the note where I gave the equipment to the creditor for the debt. So again, in that question there, office equipment, this is the note here, office equipment. It was 35,000, but then we the cost of the equipment we gave them was 15. So office equipment is 20,000. Again, I'm going to get the accumulated depreciation of office equipment. I'm after working out also in that note. It was 13,000. And if I take those away, that comes to 7,000. Now I'm just going to add these down. So the total cost, 1266000. Add my total accumulated depreciation and total net book value. Intangible assets, patents. There actually isn't any patents in this question. There's nearly always patents, but if I look at my trial balance here, I can't see patents anywhere. So I'm just going to leave that 0 or blank. And then my financial fixed assets will be my investments. So my investments are 200,000. So they will go in here, 200,000. And to get my total fixed assets now, I'm going to add my tangible fixed assets, my intangible fixed assets, my financial fixed assets, come to 1366600. Current assets. The first thing that always goes in current assets are closing stock. So closing stock, again, I've already put in the P&L, I could take it from there. Or again, if I just go to my closing stock, the most recent change, 9254. So that it went into the in cost of sales already, and also as a current asset. Debtors, I'm going to put in the debtors less the provision. So that was the last note I did working out the bad debt provision. So the debtors were 46,500, and I'm going to take away what the provision should be. Okay, the increase or decrease goes in the profit and loss account, but what it should be is what's going to go in the current asset note, 1860, and I'm going to take that away, and I might just put the 92,540 just in this column. So here I'm going to get my debtors less the provision, so I'm estimating the 1860 won't pay. So what I think I'm going to get from debtors are 44,640. So I'll add those down to give me my total current assets. Creditors, these are amounts that I owe within 1 year. So the first thing that's always going to go here are creditors. We owe money to creditors and they have to be paid. So again, I need to just get my most up-to-date creditors figure. Here we go, 6568. VAT, again, there was a note on VAT, and VAT is usually a liability, but we need to be careful. In some questions, VAT can be an asset. So it depends whether it's a debit or a credit. Remember, assets have a debit balance, liabilities have a credit balance. So with my VAT, it's a credit of 700, it's a liability. PAY, PRSI, USC, there was no change to that anyway. So that will come directly from the trial balance, 3,900. My bank overdraft, I'm going to get from my bank reconciliation. So my bank overdraft, I'm going to go up to my bank reconciliation note, 21,600. And my mortgage interest due. So remember when I had to work out the mortgage interest, I had to split it up here. The due parts, the 6,000 we got was incorrect. It's these two figures that were still owed. So that was 6,000. Sorry, that we still had to pay, they were still due. So my liabilities come to 92,768. So my working capital, my current assets minus my liabilities come to 44,412. And because that's a positive figure, I'm going to add that to my total fixed assets above. If it was a negative, I'd take it away. So 1411012 are my total net assets. Now I just need to do a small bit here at the end to balance my balance sheet. So financed by the first thing we're going to have here are creditors that we owe after 1 year. So that would be my long-term loan or my mortgage. So my mortgage here at the end of the year is 280,000. That will go here. So capital and reserves then. So the first thing under capital and reserves would be capital. So capital, we can see here at the bottom of the question is 494,000. Then I'm going to add my revaluation reserve. We have a note done on revaluation reserve. It's 220,000. Now my net profit is always the final figure from my profit and loss account, so 454012. So I'm going to add all of those, and now I need to take away my drawings. And again, drawings was one of the last notes that we looked at. 37,000. So I need to take away my drawings, and then I'm going to add that to my creditors greater than 1 year above, and that comes to 1411012. And now these two figures are the same, and my balance sheet is balanced. So the question is finished. So I hope you liked that video today, and if you did, please like and subscribe to the YouTube channel. Thank you.